Good day, everyone, and welcome to this expanded special report on December 23, 2025. In a surprising and positive turn for the U.S. economy, a long-delayed government report has revealed that the nation's gross domestic product, GDP, grew at an annualized rate of 4.3% in the third quarter of 2025, from July through September. This marks the strongest economic expansion in 2 years, far exceeding economists' expectations of around 3.3%. Let's break it down step by step, exploring what drove this growth, how it compares to recent trends, and what it could mean for markets, policy, and everyday Americans. First, a quick refresher. GDP measures the total value of goods and services produced in the country and is a key indicator of economic health. This 4.3% growth rate, released by the Commerce Department's Bureau of Economic Analysis, reflects robust activity across several sectors. It's an advance estimate, meaning it could be revised slightly in coming months, but the initial figures paint a picture of resilience amid ongoing challenges like inflation and global uncertainties. What powered this surge? At the heart of it is consumer spending, which jumped by 3.5%, the biggest driver of the U.S. economy, accounting for about 2/3 of GDP. Americans ramped up purchases, particularly on big-ticket items like electric vehicles, rushing to buy before federal tax credits expired on September 30th. Exports also soared by 8.8%, boosting the trade sector, while government spending contributed to the momentum. However, this wasn't uniform. Higher-income households, buoyed by a booming stock market and rising wealth, led the charge. In contrast, middle and lower-income families are facing headwinds from tariffs and a rising cost of living, creating what's been called a K-shaped recovery, where the wealthy pull ahead while others struggle. To put this in perspective, the second quarter of 2025 saw growth at 3.8%, which was already solid but below this new high. The last time we saw expansion this strong was in late 2023, before a series of rate hikes and global disruptions slowed things down. Economists had forecasted a more modest 3.3% for Q3, so this beat is a welcome surprise, signaling that the economy is holding up better than anticipated despite high interest rates and geopolitical tensions. Reactions from experts are mixed but optimistic. Economists note that large corporations are investing heavily in AI and technology, shrugging off tariff impacts, while smaller businesses bear the brunt. One key concern is an emerging affordability crisis, with policies like tariffs exacerbating divides. On the policy front, the Federal Reserve recently cut its benchmark interest rate by 25 basis points to the 3.50% to 3.75% range, aiming to support growth without reigniting inflation. This GDP report could influence future Fed decisions, potentially keeping rates steady if the economy stays hot.